Japan's central bank has kept its ultra-loose policy and held rates steady on Friday, citing extremely high uncertainties on the growth outlook. The Bank of Japan said it would maintain short-term interest rates at minus 0.1%, but also cap the 10-year Japanese government bond yield around zero, as was widely expected. But economists at this point think that the BOJ might be forced into hiking those rates sooner than expected, especially if the Japanese yen weakens beyond 150 to the dollar. While a weaker yen makes Japanese exports cheaper, it also makes imports more expensive at a time when most major economies are struggling to contain stubbornly high inflation. Now, let's get more on this with Naeem Aslam. He's Chief Investment Officer at Zay Capital Markets. Thank you for joining us, Naeem. Could the yen weakness then really force the BOJ to tighten sooner than expected? Is that what you think?
Thanks for having me, as always. Look, I think the BOJ has been under immense pressure with respect to its ultra-orthodox monetary policy, or as you have earlier mentioned, as an outlier. But we know that this is not something which is completely unknown or unusual, because we know central bank in Turkey has also been running a monetary policy to tackle inflation with respect to other central banks, which was completely different. And it was cutting interest rate. Only now the situation has changed. I think with respect to BOJ, yes, there is a lot of pressure in terms of where inflation is, in terms of where interest rates are. But I think BOJ is very clear. They do not want it to deteriorate the situation further in terms of the unemployment where it is, in terms of economic activity within the country where it is, not to mention the higher oil prices, which are bringing another threat for the change in the inflation, global inflation trend that we are experiencing. For instance, if you look at the Bank of England's monetary policy decision, which happened yesterday, going into that meeting, the expectation for the world increase interest rate because oil prices are still on the move, but they surprised the market by not hiking the interest rate. But generally speaking, central banks are under a lot of pressure in order to tackle inflation. But the two important things for them is that, okay, what to do with the employment market. We don't want it to deteriorate it further. And at the same time, we don't want it to have any further adverse influence in terms of the economic activity.
Right. Naeem, is that why then the central bank officials have been very cautious in Japan about exiting the ultra-loose policy, even though core inflation has exceeded the BOJ's stated 2% target? Is that the reason, or are there other reasons behind this move?
Well, look, I think core inflation is running extremely hot in relation to all central banks and where their targets are. The only thing that they are doing now is they're shifting the line in the sand further, closer to reality. The reality that we face in this higher oil prices environment. And it doesn't seem like that these oil prices are going to come down anytime soon, given what the OPEC nation and their stance is in relation to. So the BOJ is looking at, okay, what shall we do? Shall we follow every other central bank and then tighten the monetary policy to an extent where it is going to have a much more adverse influence on our economy? Because if you look at the UK, the situation is completely dire. The Bank of England has been pushed into a corner. The real estate market is in absolutely dire condition. And so the BOJ is really looking at other central banks, what they've done by exiting the dovish monetary policy and adopting this ultra hawkish monetary policy stance. And BOJ has seen where their treasury yields are moving, because look at the treasury yields in the United States, the 2s and 10s. They are sitting at a multi-year high. In fact, the levels that we haven't seen before the financial crisis. Look at the yields in BOJ in Japan, where they are sitting. So BOJ is saying that, okay, you know what, we're going to keep the monetary policy at a level where it continues to provide support for the economy, because we know where the situations are for the banks which have adopted ultra-hawkish monetary policy.
And something that we'll be monitoring very closely. Thank you very much for this interesting analysis, Naeem Aslam.
Thank you.
And now let's go to other top business stories from around the world. An Australian Union alliance has called off strikes at two of Chevron's major liquefied natural gas plants, a standoff that could have affected almost 7% of global LNG supply. The Union Alliance reached an agreement with Chevron on improved pay and working conditions to end the strike that began 2 weeks ago. Drafting of the agreement is still ongoing, and members of the union will soon cease industrial action. Silicon Valley giant Cisco has agreed to buy cybersecurity company Splunk for $28 billion, marking its largest acquisition ever. The deal will help the world's largest maker of computer networking equipment to bolster its software business to protect users from data breaches. Shares in Cisco fell around 4%, while Splunk shares were up around 20% after the announcement. And the International Monetary Fund has approved a $300 million loan deal for Burkina Faso to help bolster its economy and reduce poverty. The global monetary body said the first tranche of $32 million in aid will be disbursed immediately. The West African nation is navigating one of its worst economic crises following 2 military coups since January last year.